Monday, April 19th. Welcome to episode 1999 of Market Foolery. I'm Chris Hill. With me today, Mr. Bill Mann. Thanks for being here.
Chris, how are you?
I'm good. I've got coffee, so I'm good.
I'm going too.
We've got a deal in the furniture industry. We have surprising news out of Harley-Davidson, but we're going to start today with Big Red. Coca-Cola's first quarter profits came in higher than expected. Organic revenue grew 6%. Coke shares up slightly this morning. I got to be honest, this quarter was better than I thought it was going to be for them.
Well, they reached back to the same levels that they had in terms of overall case volume that they had pre-COVID. So they've re-hit those levels. And tell me if this sounds surprising to you, but on a regional basis, their earnings were up. Their sales were up 18% in Asia Pacific, 9% in Latin America, about 4% in North America, and then minus 8% in Europe and the Middle East, which to me graphs very closely with how regions are doing responding to COVID-19. So it was a great quarter. Yeah.
I think it absolutely does pair nicely with what we're seeing in terms of COVID levels. I guess the surprising part to me was North America doing as well as it did when you think about the away from home segment, and how important that is for Coca-Cola. And there's still so many. Just think of the last 3 months. There's so many stadiums, so many concert venues that are just either, if they're not shut down completely, they're operating at a fraction of the normal capacity.
Yeah.
That's why I thought this was a pretty good number.
It was a really good number. I mean, yeah, obviously they're still doing some figuring, and we have not thrown open the doors. Chris, you are forgetting about the massive effect of Coca-Cola Black, the Coca-Cola and coffee product that they've released. But no,
was it massive?
No, it wasn't massive. It was just incredibly important for us coffee drinkers. No, and Coca-Cola, to its credit, has said, because this is a bellwether company for the exact reasons that you're talking about, people are looking at Coca-Cola as having a very good insight into how things are opening. And their CEO was James Quincy was pretty negative about reopening around the world, saying that, and he didn't name countries, but we could guess what they are, that they're going the opposite direction that we would hope in terms of opening. And so that, that away from home segment is going to continue to be impaired. I'm staggered at the quality of this quarter.
Yeah.
I'm staggered at it.
It's one of those things that I think if you're a shareholder, you're maybe trying not to get your hopes up for what could come with further reopening in different regions, because if Coca-Cola can put up these kind of numbers in the environment that we've seen over the last 3 months, it bodes well for how they could perform as things continue to open up.
I think that's exactly right. Right.
Last thing before we move on, they in a separate filing, they announced plans to do an IPO. They didn't give an exact date, but it sounds like it's coming in 2022 of Coca-Cola Beverages Africa. This is going to list in Johannesburg and Amsterdam. Is this, if you're a current shareholder in the US, is this a benefit to you? Is this something you're excited about, or does this not really have any effect on you?
I mean, so when they list, Coca-Cola and the Coca-Cola complex is it has a lot of different elements. The bottlers are separately traded companies. There's Coca-Cola Enterprises in the US. There's Coca-Cola Isacek, which is in Turkey, Pakistan, a lot of Iraq. There's Coca-Cola Hellenic. So they actually have Coca-Cola bottlers that are public all around the globe. This actually is going to be pretty interesting, but Coca-Cola, you won't see as a shareholder, you won't see money distributed to you. You probably won't see shares distributed to you. To me, this is an interesting listing because this is one of the last huge potential growth markets for sparkling beverages.
First quarter profits for Harley-Davidson were much higher than expected. Revenue came in about as expected, but Harley-Davidson raised guidance for the full fiscal year, and shares are up more than 10% today. Speaking of surprisingly good quarters, I mean, the 1-2 punch of the numbers they put up,
Yeah.
and just not being shy about the guidance for the full fiscal year. Yeah, I get why this stock is up today.
No, they put the hammer down. I mean, so they had 32,000 motorcycles that were sold in the U.S., in North America in the first quarter, which is up 30% over the same quarter last year. Again, probably a little bit of COVID effect in that, but the first quarter of last year was only impaired in March, so probably a pretty good comparison. The really interesting thing, and I know we've talked about this a lot on the show, is that we think that the biggest risk for Harley Davidson is the fact that its primary demographic is aging, that it's basically older white dudes, right? And so Harley Davidson has essentially doubled down on that core demographic. They're going out with more expensive bikes. They're actually ramping down. They had pretty poor sales in Europe because they're getting rid of some of their less profitable, the Street and the Sportster, kind of the stripped down models. They're going with their turnaround plan is doubling down on the big, expensive, high margin touring bikes. And in the words of Pepper Brooks, it's a bold strategy. Let's see if it works out for them.
So I can see this working out, and certainly you look.
I can too. Yeah.
You look at the stock movement today.
Yeah.
There are others who believe this worked out. Is this an effective long-term strategy, or is this a strategy that you can execute for the next couple of years because you have the combination of people have been pent up in their homes for a year? In some cases, people have seen their own personal savings rate hockey stick, up and to the right. And so, yeah, this works over the next couple of years, but maybe beyond that, they need to revisit.
It's a really interesting question, Chris. And I think that probably they're retrenching a little bit. I mean, something else that's coming down the pike, and the news came out earlier today that Harley was being slapped with a 56% tariff in Europe. So that probably they had to see this coming down the pike, and so this probably had to do, probably had something to do with the fact that they are retrenching and moving into the bikes that sell really, really well in the United States. Harley does have a risk that they will dilute their brand by virtue of going into other areas. I think probably that they're in the process of retrenching, centering on the thing that everyone associates with Harley Davidson with, and then they're going to try and figure out how to make that experience relevant to additional demographics than their core. So I think it's smart. I also think, I also think that what they have done till now hasn't worked that well. So they kind of had to retrench.
Merger Monday is living up to its moniker once again. Herman Miller, the office furniture maker, is buying Knoll, a furniture and accessories company, for $1.8 billion in cash and stock. And depending on which side of this you're on, you're either thrilled or more than a little disappointed, because shares of Knoll are up more than 30% on this news, while shares of Herman Miller are down more than 11%. That is, I don't remember the last time we had that kind of delta.
Yeah, getting paid. The Knoll shareholders are getting paid. Part of this has to do with the CEO of Knoll. The chairman and the CEO is a man named Andrew Kogan is planning on retiring. So I think that this is a closeout for them. And we do this a lot with companies that we analyze. You look at the you look at the age of the managers who you trust. And say, is it likely that they're going to continue operating? And I think that in this case, it was pretty clear for some period of time that he was looking for an exit strategy. And so we've got it. I'm not sure that the Herman Miller people are that excited about it. They're touting the deal as being a way to consolidate. They both have very deep, very deep Michigan roots. So there's a fair amount of consolidation that they're claiming can be done. But yeah, I think the Herman Miller shareholders are reacting because they're wondering why it is that they are paying for Andrew Kogan's retirement party.
So this is about the price tag and not necessarily the deal itself, because on the surface, at a lower price, absent the price tag, this is a deal that I'd sort of look at and go, okay, that's not crazy to me.
Yeah.
So maybe it's just the 1.8 billion.
I think that's probably it. And I haven't seen the details on it. I would love to know how they're financing it. Right. Like it could be that Herman Miller is changing the focus of its balance sheet in a way that makes people nervous. I mean, furniture is a hard business. And so I'm sure that there's some nervousness that they are wasting capital taking out Knoll at such a high premium.
Last thing, and then we'll move on. Combined, this is a business these are two businesses that have a combined market cap of less than $3 billion.
Yeah.
That said, they're both in the same industry. When it comes to regulatory approval, I mean, I looked at this and I thought, oh, these are, relatively speaking, these are tiny companies. This will be rubber stamped, no problem. Is that always the case? I mean, I don't see anyone talking about this particular deal as saying, regulators might not let this one fly. But is it always the case that it has to do with the overall market cap? Because certainly, you just think back to earlier this year when Visa walked away from the deal with Plaid.
Yeah.
And, that was over regulatory concerns.
Yeah, I think in this case they aren't going to have much of an issue. It is always interesting. I mean, there was a case probably 15 years ago now where two shoe companies were not allowed to merge on antitrust, for antitrust concerns. And I thought to myself at the time, like, the shoe industry isn't, I really don't understand what the protection of the consumer for preventing two shoe companies from merging would be. And I don't know what, ultimately, when you think about antitrust, it's not so much the public company element, it's the protection of the consumer and the market. So it really depend in this case in how the market is defined. If it's defined strictly as office furniture or modern design furniture, there could actually be a case, but I don't really see those as being markets that are in that you could protect in that way, right? I just don't see that there are really big concerns for these two companies.
Before we wrap up, we are really at the top of the first inning of earnings season. So many companies left to report. I'm curious if there's anything in particular you're going to be watching this season, whether it's a company, an industry, a trend. What are you going to be looking for?
So there are two things that I'm really interested in, and the first of which they both are around the same theme, which is a year ago, the earnings were first impacted deeply by COVID. So you think about the companies that are the quote COVID plays, like Zoom, for example, and then you think about the companies that were most deeply impacted by COVID, which would be the strict retailers. It's going to be really interesting to see, to me, how they are, how they are emerging. We don't know. We never know, but we really don't know what the economy is going to look like 6 months from now. We don't know what people's patterns, what their practices are going to be like now. Or we're going to be 6 months from now in the United States, are we going to be looking back and saying, hey, you remember when we used to wear masks? That was crazy. Or are we going to be back, or will there be deeper concerns? So this will be the first quarter in which we have not particularly great comparables from the year before, but I think we're going to start to see some real information from the companies, how they are thinking about how the next 6 months to year will be.
It really will be fascinating to see what the different puzzle pieces look like in terms of forward guidance. And again, to go back to Harley Davidson, I mean, it's one company in one industry, and yet they feel good enough about what they see over the next 9 months where they were able to come out and say, yep, this is we're ratcheting up our guidance. Here's why. Here's what we see. And to your point, it'll be interesting to see what we get out of the bigger companies, the bigger retailers, the more bellwether type businesses as well.
Yeah. Yeah. I mean, we've seen companies like Costco, companies like Walmart and Target have, I don't necessarily want to say sailed through, but they have absolutely consolidated market share during this time. And they have shown themselves in some ways to be Amazon proof. But it will be really interesting to see if consumer habits shift back away to where they were beforehand, or if we have gone through permanent change in how consumers choose to interact with these companies.
Bill Mann, always great talking to you. Thanks for being here.
Thanks, Chris.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.